Hello, ladies and gentlemen. My name is Greg Michalowski. I'm the Chief Currency Analyst for FXDD, and I'm here as a guest and an honored guest to be part of the FX Street webinar series. I do these, I'll try to get twice a month in at FX Street, and I'm most grateful for the opportunity, and it's an honor again to be able to speak with your audience and FX Street audience. They do a great service for you. Do not take them for granted. They're great service. Before we get started, let me remind everybody that we're not here to give buy or sell or hold recommendations. We're here to give you some education in regard to how to approach, how to look at the foreign exchange markets. And so this disclaimer warns you once again that trading foreign exchange is risky. That can lose all your money trading foreign exchange. I'm going to try to stop you from doing that by doing things like defining risk, and hopefully you won't blow up your account. I just did another webinar, and someone mentioned to me that they blew up your account. We don't want that to happen to you or to anyone out there, and hopefully what we teach you as far as education is going to allow you to stay in business, because that's the goal of every business. Well, this market is, what I want to talk about here today is this current market that we're in and how to trade it. And I was in San Francisco last week at the San Francisco Money Show, and as you do when you present, especially in front of a live audience, not that you're not live, but a visually live audience, is that you I tend to get up real early, turn on CNBC, and start working on my slides. And of course, the markets were in total disarray. The gold was going here, the stock market was going up and down, huge amounts of points, and oil was moving fast. The dollar was going back and forth, and they were talking about fear. And that's okay, but there are ways that you as a trader can control fear. But what we know now, and we're going to go through them today, but what we know now is that the markets are very volatile. These are probably historic types of markets. These aren't markets that are in the normal bell curve of what you and I are accustomed to, nor I hope that that this trend of volatility stays with us. I hope to get more into a normal markets, but I believe certainly in the idea that there are cycles in everything in life, and including trading and trading, and in cycles in life, there's cycles in trading, and this is one of those cycles where it's very volatile and historic. It's news driven. It's fear driven, like they were saying on FX on CNBC. And also the markets can be characterized as, especially in something like the euro, trending and non-trending. Well, you ask, how can it be trending and non-trending, Greg? Well, the answer is that if you look at the euro dollar, let's say on a hourly chart, you can have trends that move to the downside in a nice fashion intraday, and the next day trends to the upside. So, and also we'll get to these charts in just a second, but or in a little bit. But what you'll find in these in the markets is that if you look at the 100 and 200 hour moving average as an example, it's kind of going sideways, and they're both kind of in the middle of this very volatile situation. So I call that market that's a market that's trending and non-trending. So these are tough times, but let's try to make sense of what to do and how to do it. My approach that I take is very similar in other types of markets. There's no difference, but there are some adjustments and expectations have to be different. Now, the one question I want to ask you, is it realistic to think that trading will be relatively easy in this environment? So first off, if you're having a tough time in this environment, the answer is no, it's not easy. It's not easy, especially for a retail trader. I can't imagine what it would be like if I were didn't have the experience that I have to understand what type of markets it is, how to read the market, how to be a little bit extra patient in this market. And one of the things that I try to tell traders in this types of markets that we're in, this historic, this volatile, this news-driven, this trending and non-trending market, is this, that that you want to take the idea that, okay, I am in like with the market. I'm not necessarily in love with the market. I'm not going to marry this market. I'm not going to go to the altar with this market and say that the euro is going to go down because of Greece, because of Italy, because of no euro bond, because of whatever. You start to fill your mind with all these reasons of why the euro should go down. Next thing you know, the euro goes up like it has over the last few days. And vice versa, the dollar as well. You can sit there and say, well, things are getting better, or this or that, and the dollar should get stronger, or maybe we have this, it's hard to even think of good things, but, there are things, that may cause the dollar, that you might think the dollar, well, let's talk about the negative stuff, that the dollar will go lower. Next thing you know, you get a 200 or 300 pip move in the euro dollar, where the dollar gets stronger. So what you have to do is you like the market, you don't marry the market. You can, how do you know when to break up with your girlfriend, if you will, to stop the trade? You let the market tell you when to get out, okay? And you do that by using things like technical analysis in your market. So is the market impossible? No, but you will need what I call trader's luck. And people will say, well, what's he talking about, trader's luck? Well, trader's luck is this, and this is different than blind luck, okay? Trader's luck is achieved by being patient, trading near key support and resistance levels in an attempt to anticipate good trade location, or sometimes great trade location. If good trade location is anticipated and secured, you will either lose a little or get lucky, okay? Get lucky in the eyes of your friends, not mine, though, okay? And you should make a multiple of amount of risk. Those are your trading friends. Your other friends who don't know anything about trading won't know what you're talking about. So what you have to do is put the odds of success, if you will, in your favor by being patient, waiting for those keys and support and resistance levels. And this is no different than what I tell everybody every day. All the time, traders should look to define their risk, keep your risk to a minimum, make sure that you accept your risk, and then have different reasons to do a trade. If you can do this, then what you're working for is good or great trade location. And that will allow you to be able to take advantage of these swings in the market. And if you're wrong, we won't hear about them, you won't be typing them on the Twitter pages or whatever, but your losses will be limited and you won't be blowing up like that guy for the gentleman in my last session who admittedly, he said he admitted he did mistakes and hopefully learn from the mistakes, and he was coming to the webinar to get some knowledge, and then hopefully I gave that to him as well. So that is trader's luck. By the way, what is blind luck? Well, blind luck is when you as a trader don't have a reason to trade. You don't trade near key support resistance levels. You just kind of have a hunch, bet a bunch type trade. And the next thing you know, you get lucky and the market moves in your favor. And guess what happens the next time when you try to do the same thing? You may be wrong the next time. And guess what your mind does after that point? When the market doesn't do what you think it did it worked the last time, why doesn't it work this time? Well, guess where your mind's going to be out going forward after that. Sorry about that. After that, and your mind is going to be so confused you're not going to know which way is up as far as your trading goes, and so you are just doing yourself more disservice by having blind luck. Anyway, anticipation. I used the word anticipation in the last slide, is needed to effectively trade trends. Anticipate. How many of you people use the word or think of the word anticipate? And I'm sure there's not a lot of you, but think of that word anticipation. It's a very important word as far as your trading. You start to anticipate what may happen. Successful traders that need to see the future by anticipating the future. Well, what kind of crystal ball does Greg have? How are you supposed to anticipate the future, Greg? And the word anticipation is really no different, or thinking about the word anticipation in your trading, thinking about what the future may bring in your trading is no different than what Apple Computer or Doctor or a successful athlete do to succeed. All anticipate. Think of Apple. When they developed the iPad, it wasn't like there weren't any tablet PCs out there. They're bulkier, yes, but Apple thought, hey, let's anticipate what the consumer would want. We see this need for this portable screen, and so this portable computer, and they made this product that's sleek, that's thinner. This is what engineering's about. They anticipated the demand. They also anticipated what would go on that thing, and they started to call them apps, like Apple. And funny how they snuck their way into that, you know. So now what does Motorola have, or, you know, the other products out there that have these now tablets do they have to use apps too, like Apple? You know, doesn't it make more sense? So they were the leader. They anticipated what the demand would be, and they've developed this customer base. And no matter if you know, some other device is better, you know, people are going to go to the Apple. Why? Because they're there first. They anticipate what may happen. Doctors anticipate all the time. They have an idea of, you know, they never know, you know, unless, you know, they don't know what it's going to be like when they operate on someone, but they anticipate what may happen, and they're quick to think, and God bless them. Anyway, and then athletes, they all anticipate. And I've said this forever and ever. I've always said that traders, in order to catch a trend, in order to stay on a trend, in order to find good trade location, you do have to anticipate. And I always said that it's like a baseball player. A baseball player needs to anticipate the pitch, and if you in order to hit it, they have to. And quite frankly, when you go to Google and you type in, I was looking for a fastball, you're going to get the quote from the guy last night who hit the game-winning hit. He was anticipating a pitch from the pitcher, and that's the pitch that he got. He was able to see the future by guessing, if you will, anticipating where that pitch would go. And how did he anticipate a fastball? Well, because the pitcher got him out the 3 innings before by throwing a fastball. It's the same in other sports. You can think about the word anticipation. American cricket too. They anticipate. Brian Lara, the where did he play for? The West Indies. I was there in England when he had a 504 score in a cricket match, and the cricketers anticipate where the pitch that's coming in the dirt is going to go. And they're great anticipators as well. But anyway, there's an article in Sports Illustrated, August 8th. It's all about anticipation. By now, you've all read. Ryan Howard, he's a baseball player, and Rafael Nadal, he's a tennis player. Do not have quicker reflexes than you do. They hit the fastest pitch and return the hardest hitters because they can see the future. They are us. They are traders. Traders need to see the future. How do they see? How do these people see the future? By looking at the pitcher's arm, by understanding the bowler in cricket, where they're coming from, and how the trajectory of the ball is going to be. It's all in the motion, is what this article was saying. That if you took out, if they blocked off the arm, they wouldn't be any good at pitching, or at hitting. They just understand, and so that's the same thing as seeing a chart, isn't it? You look at a chart, you recognize something may happen, you define your risk, you understand what your risk is, and then you start to trade. So, how do traders anticipate? By using technical tools that allow you to potentially catch or help define a trend. That is, hit a home run or hit a six in cricket. I use 3 technical tools: trend lines, moving averages, 100 and 200 Fibonacci retracements. I use them in non-trending markets. I use them in non-volatile, non-news-driven markets. And I'll use them in volatile markets as well. Each of these technical tools are what I call unambiguous trading tools. They tell you if the bias is bullish or bullish or bearish by comparing the price to the tool's value. For instance, let's take a look at this chart, and this is at the beginning of this month where the volatility really started to take place. The market started to move up and down and up and down. But at this point right here, can you define your risk against this double top right here? Yes. Can you anticipate something may happen? Well, either the market's going to go this way or it's going to go that way. Right now, it's showing a direction to the downside, and actually gives you the clue right here. When the market hits the peak right here, the market started to move down, and as you can see, we moved down to where a support area right here. And this is what you as a trader have to start to do in these types of markets, is anticipate a move lower, define risk against the double top. market moves 100 pips in over the next 4 hours. You take it and you run. You don't become married to the position. You like it. All right, let's move a little bit further and take a look at this line right here. This is a trend line, and what do we have here in these in these volatile markets? You can also just draw trend lines against lows. We have 1, 2, 3, 4, 5. You can see here how the market low this line starts to develop here over time. Well, I'm talking about this period here where the market starts to rebound, moves to the upside. Can you not draw a parallel trend line that takes 1, 2, 3, 4, 5, just come up and connect it to the high over here and see when the market starts to move to the upside, anticipate that there may be something that may slow, that this may be something that may slow the market down at this point right here? Can you anticipate, or at least know that that line is there, and if the market starts to move down and maybe gets below this line right here or moves in this area, holds this level right here, that maybe it's time to be patient, that patience that you've been having, that reason to a trade is something that you can take advantage of. Take advantage at this point. Despite the volatility that the market's having here, despite all the news and stuff, traders always look to define their risk, to find levels that they can trade against. And that's what you as a retail trader have to do as well. Define that risk. Define that risk against a line there, even if it seems so remote that it's so far away, but you take this line, you connect it to a high here, and you put it in there, and you say, oh, well, what happens? Well, look what happens. The market starts to slow down at this area. Can you see the market slowing down? This is an hourly chart here. This is 4 hours here. Beginning of the day, the market is slowing down at that level. It's defined this. It's defined that. Where is your risk if you sold the market against this level? Right here, right here. Let's take a half a box here, okay? Let's define our risk as a half a box there. And if you sold the market at this level right here, if you had that trader's luck and came in the market and thought, hey, you know what? We just came all the way down. We came all the way back here. I'm going to sell against this trend line. This is going to be my trade, and let's see what happens. I can define my risk as a half a box here. This half a box right there. I'm going to define it against there. And if I make a full box right to this point right here, I'll be happy. Oh, well, how about 2 full boxes? How about 3? How about 4, 5, 6, 7, 8, 9? These are the types of things that these types of markets may allow you to do. So then I say, well, okay, you don't want to marry a position. You want to you like a position. So when the market comes down here and it goes down 1, 2, 3 or so boxes, what do? We get a big move to the upside. Well, we start to use other tools in this process as well, including the 100-bar moving average here. The market moves above that level, and you take your profit at that point. When it moves back below the 100-bar moving average, what does that turn your bias to? Are you still bullish or are you now bearish? Well, this is the importance of using what I call unambiguous trading tools. Trading tools that give you either a bullish bias when the price is above or a bearish bias when the price is below. Obviously, something came out at this point right here on this day, August 4th, where the market took a sharp move to the upside and then came right back down. You should use that idea or use these tools as ways to take profit and then maybe even get back on the trend, and hopefully you catch even more of this trend, or at least recognize that the bias is to the downside. And don't trade against the trend. Look to trade with the trend on the way to the downside. And then you can stay married to the position, have the position move further to the downside. Okay, let's move on to the point number 6. We saw in this previous chart right here where the market came down, and where do we come down to? Well, 1, 2, 3, 4, 5, and now we have 6 down here. The market came down to our support level against our support trend line. These are all in the volatile markets, the news-driven markets that we've developed here. And what we saw here, point number 6, is that the market did move below that level. And if you were astute, or if you're a trader and you're short from up here, moving below that level may prompt you to sell some more. It may also prompt or a trader to actually think about selling the market because we're breaking through this key support level of 1, 2, 3, 4, 5, 6. But what should a good trader also do when they trade against a certain key level also after we come down a pretty good ways here. This is about 300 pips to the downside here. What should a trader realize as well? Excuse me, and that is that the market may stall as well at this level. And if it stalls at this level, what do you have the potential to do? Find some support against that level, just like we found resistance against this level. And lo and behold, the market moves a little bit below that line here. May have stopped some people out who may have bought against that support line. But when the market starts to move back above this level, what are you doing? You're getting out and perhaps even thinking about, well, maybe I'll play for the corrective move, 38.2 of this move or whatever. What does the market end up doing? Rocketing back to the top side here. This is the Friday before the S&P downgrade here. If you kept the position open over the weekend, the S&P downgrade, the market moved further to the upside and started to move back to the downside. So trend lines are one of the technical tools that define risk. By defining risk using a trend line, traders can start to anticipate a trend. They can also are able to do what I call keep fear to a minimum. If you can define your risk, you can limit your risk as well, and that is what you as a trader start to try to do, is define your risk, keep your fear to a minimum, and in the process you make trading a little less difficult. It's still difficult, but a little less difficult. I use 100 and 200 bar moving average. 100 is blue, the 200 is green. We already talked a little bit about it. The 100 I call my trigger. Trades are initiated there. The 200 is what I call my confirming. It helps confirm the trends. Moving averages are also unambiguous. They help define your risk. They allow you to keep your risk to a minimum, and because risk is limited, fear is reduced. Keep your fear to a minimum, folks. Fear is a trader's worst enemy. If the trend is your friend, fear is your enemy. Trade. Be cognizant of your fear. Traders can anticipate a potential trend or a breakthrough a moving average. So here's our moving average. We're looking at the same charts. The market broke through the 100-bar moving average here at this point right here. It gave you a trigger to sell. The market confirmed through the 200-bar moving average, moved to the downside. What do you do here when the market breaks above the 100-bar moving average? Well, that's giving you a buy. Hopefully you're buying. You're buying more toward this area as well. But note here, what else is happening over at this point? Remember when we looked at those trend lines here, and we're looking at the first trade where the market had a double top there. Now we introduce another technical tool in the picture, and this is the 100-bar moving average. So when you're trading in volatile markets, if you have multiple reasons to trade, is this a way that increases your confidence in the trade? And the answer is yes. So look for multiple reasons to trade. We're breaking above these double top right here, which sent the market to the downside. We're also breaking above the 100-bar moving average, not far away from that double top. You can see how the market came up to the double top area initially, moved a little bit to the downside here, and then regrouped and said off to the top side here. And so this was an opportunity for you in this volatile market to take advantage of not only breaking above the double top, but also breaking above the 100-bar moving average. Look for those multiple reasons to trade, folks, and they'll provide you with good trade location in your trade, allow you to good to great trade location, allow you to profit from it. Now, the other thing that I want to point out is that when you get in a trade and the market starts to move in your direction, what do you do for then? You have good trade entry, and that's part one of a trade. Now you have to manage the trade. And part of managing the trade, especially in these volatile markets, is to make sure that you get to your next targets. So one of the next targets in the volatile markets becomes the 200-bar moving average. So the market has to get up and through that level in order to keep the bullish bias intact. The next level to get through would be this level right here. And then another level would be this trend line, this parallel trend line here. All these become targets in our trade. So just getting in the trade here is step number one. You've defined your risk. You put your risk on a move below this level right here. So you're risking a half a box here in the trade or so, and then the market moves up. And even if you make one or two points, you still got to get to that 200-bar moving average, don't you? So what happens here? The market moves up, and we can't get to that 200-bar moving average here. This is part of that volatile, of the markets that I speak about, where you can't, if the market's not trending, well, let me put that again. If the market tells you that it can't trend, guess what? it's going to turn around in these volatile markets. You're going to see the market find sellers against resistance levels after a time. So the market comes up toward the 200 bar moving average and says, we're not that bullish just yet. We just did this, we did this, we did this, and we're not bullish yet. So what do we do? We come down to the 100 bar moving average, and then we move back up to our high here and to the 200 bar moving average, and then the market says, no, we're not ready, and starts to come down. So we get these types of markets. So if you're long at this point right here on the break of here and here, and you see this market fall short of the 200 bar moving average, take some profit. That's another thing in these markets that we are in right now. If the market doesn't do what it should do, that is, doesn't reach its targets that you're supposed to get to, take some profit up there. See if the market may retrace down to this level and then rocket up through that level. You don't know in these types of markets, but take a little off the table so that you know that you have a little profit in the bin, a partial position, and then if you see it come up here again and the market it fails again against the 200 against this high right here, take the rest of it and see what happens at that point. This is where you're saying, hey, I don't want to be part of this market anymore. I want to stay a little bit to the sidelines. And so you have to recognize that, and the way you recognize that, folks, is by having your good or excellent trade location for a number of reasons, and defining targets. Define targets along the way. If you can't get to that target, be a little skeptical about what may happen next. Be a little bit, less bullish on your position, and make sure you take a little bit of a profit. So Boyke is asking, do you consider long-term trends? Not in these types of markets, Boyke. The market is doing what it's doing because it doesn't know what it wants to do, okay? And I know, you can take a look at the euro or whatever and say that the euro is up at 140, and so it's an upward trend, but, what is happening here is not usual. And he's asking, usually, yes and no. Markets get overbought and they get oversold even in a trending market. I will look to trade the trends, and I'll look to use the resistance levels on a trend as points of taking profit. And it could also be point to trade against a trend. So let's just play what if, okay? Play what if that this is a longer term trend right here, and the market comes up to, well, actually, that's not a good example. Anyway, imagine that you're in a trend channel. Yes, okay. Say we're in this channel to the upside. The bias is bullish here. Well, if I'm long here against the 200 bar moving average, and the market starts to move higher here, I may look to sell against this upper end of this channel. Why? Because I have this trend line here. This trend line is a parallel trend line off of these lows. I connected to this high right here. I know we went above it there, but then the market started to reuse that trend line as a resistance level both here and here. And when the market moved up to this point right here, I can also go back in time, and I can go back to this area right here where the market was basing here, and then use that, and the market fell sharply through that level to the downside. So I know that this is a good reason to sell, and so even though the market's in a bullish bias here, I'll go to the downside. Assume that's a daily chart in the Swiss and whatever, it's just what it is. It's in my mind. I look at this and I see a bullish trend, and this took the market, I know, off the longer term. It's not a bullish trend in the dollar versus Swiss, but I will take that into consideration, the fact that we're up there against that resistance. Do you take every trade when the price reaches the top or bottom of the channel? On what other conditions or indicators do you use? No, I don't necessarily suggest that you take every trade out there. And again, I use 3 different tools. I use the trend lines, I use moving average lines, and I use Fibonacci retracements. I don't recommend that that every trade be taken. There are different circumstances in every market, but I'm looking for those low risk trades against these key levels. And if I have multiple reasons to think that a level may hold, that increases my confidence in the trade and allows me to take advantage of that. Take advantage of that knowledge. and that's what good traders do. That's what good hitters do. That's what good cricketers do. That's what good tennis players do, is they anticipate by putting the odds of success in their favor. So anyway, okay, back to our little presentation. We'll kind of zip through here, and then we'll get into the current market. So, moving averages in these markets as well. Here's an hourly chart looking further down the road. The market moved above the moving average here, came up to the 200-bar moving average, consolidated, moved back above that level. When the market started to move back to the downside, notice here that we moved above the 200-bar moving average here, sent the price moving to the upside. Here, when the market started to come down, what did we do? We came right down through old level here. This level corresponded with these highs here, again, the double tops here, to the 200-bar moving average, through this trend line again. So we had multiple reasons here why the market should divorce itself from the bullish bias here and look toward the downside here for the euro versus US dollar. So, in these markets, the point is that you have to be very nimble. You have to be watching the key levels along the way, and make sure that you define your risk against these levels, and then move the market through. So the question asked is, aren't too slow 102 simple moving average? Why not use 21 of the 50 simple moving average? I would say that in these types of markets, where the markets are very volatile, working in large ranges, the 100 and 200 bar moving average work just fine. In fact, it slows the volatility down a bit. But in honesty to your question, there as well, is that I will not only look at the hourly chart, I'll also look at the 5-minute chart and the daily chart to get clues if the market is doing something off of the 5-minute chart. You can imagine, however, if I had a 21 bar or moving average in this period right here, how many times the market, it may be a lot more volatile than this 200 bar moving average. And I personally find that the combination of the 100 and 200 hour chart, or 100 and 200 bar moving average on an hourly chart, and then looking at a 5-minute chart as well, gives me very good, the equivalent of maybe of the 21 and the 50 in a normal market. So I kind of use a combination of it. I don't really want to. It's impossible for me to go through not that it's all exhaustive, but what I'm trying to focus on in this session is trying to make sense of this market. I don't think this is a new normal environment. We've been through these cycles before. We had volatility, this type of volatility before. We'll get into more normal circumstances here. I just believe it. And the final thing is Fibonacci retracements. These two are unambiguous tools. I use these to measure the corrections within a trend move, or to also tell you when the trend move is over. So it's an important tool as well. And I use a 38.2% retracement is the one I like to use the most to give me clues as far as whether the trend is going to continue or the trend is going to end. 50% retracement can be focused in non-Transn trending markets. 61.8 is less. I want to move a little bit forward because I want to go into the current markets. These are older examples here, but let me see here. Which chart I want to look at? Okay, this one right here. Remember, we were looking at this is that S&P move where the S&P downgraded the Sunday night move and the market started to come down. Well, this is where things start to get things in place here. We had our bottom trend line. We have our top trend line here. We have the 200 bar moving average. We have the trend line. We also can put a Fibonacci retracement from the most recent low to the high here. This trend moved to the high, 38.2% retracement. All come in at the same area right here. So when all these levels came in at the same area, was this a key level for you as a trader to take advantage of, to think about going long or short at that level, to think when the market breaks through that level to actually sell at that level? And I think you probably all agree that this was one of those levels in this world of volatile price action where you as a trader could have, in advance, understood that what the importance of this level is. And this is what differentiates the boys from the men, the women from the girls, and the better traders from the not so better traders. And that is by being able to use tools like the 200 bar moving average, and understand things like trend lines, simple tools where you take the highs here, you understand those highs, that brings us a horizontal line. We also have this trend line coming down here, and the 38.2% retracement all coming at the same level, and that allows you to work this trade, have the market work in your favor to the downside. So I know it may seem like hindsight is 20/20, Greg, but what you as a trader have to do is be aware, be prepared, understand where these key levels are, and that allows you to take advantage of the situation. And it wasn't a surprise to me that when the market broke through here and actually corrected up and gave you a second chance at this point here, that it was an opportunity for the market to move further to the downside. You can define your risk. You can keep your risk to a minimum. You can anticipate a move to the downside. So in the last few minutes here, I'll take some. I'll turn my screen off, come back to my chart screen, and we'll take a look at the euro versus U.S. dollar. Try to make a little bit of sense about what the market is looking like now. Let me first check to see if there's any questions here. In the euro versus U.S. dollar, we've continued with this volatile action. I zoomed out here to show you this. These are my original trend lines that we saw in the chart, and we've gotten into even more volatility at the end of last week on Thursday and Friday. This type of action is, if we have this as the new normal, folks, we're in trouble here. This type of volatility is not what we're looking for. What we're looking for is a little bit more, even, in hindsight, or if you take a look at the bigger picture from those charts that I went through in my presentation, it made more sense from how I drew the Fibonacci's, how I looked at lines and so on and so forth in those charts than it does in this area right here. This is very volatile. This is historic. But let's take some of the volatility out by looking a little bit more closer at the market here, looking at the euro versus U.S. dollar. And again, like the previous examples, oftentimes in these types of markets, the traders will start to look for any clues that they possibly can get their arms around. Any clues that are visual, that are simple, actually trump the harder ones, okay? This isn't time to get complicated with the market. This is a time to simplify the market. So I draw your attention to the beginning here, all right? And this beginning doesn't necessarily have to be developed at this point right here. It could be developed as time goes on and as you see the market develop in this region right here. But what can we say about here and here? We can take a low and another low and put a line in there. We can take this line and we can copy it and put it along these tops right here. And we can see that, hey, there's a pattern developed here that is that the market is showing. We have 1, 2 lows here, and we have 1, 2, 3, 4, 5 highs here, and we've developed a channel. We've developed a channel. And so when the market starts to do its thing here, and we find support or we find that the market finds support here, and which, by the way, is against the 38.2% retrace of this move to the upside here. Take the low, move it to the high, correct to 38.2%, move higher, correct to 38.2, find a base, move above the 100 and 200 bar moving average. Is it bias bullish? Yes. Can you define your risk? Yes. Can you keep your risk to a minimum? Yes. And the market starts its move to the upside, a trend to the upside here. When we get to this point right here, should the market stall at that level? Yes. Does it? No. So if you're a sell at this level right here, get out right here. All right? This level also corresponds, by the way, with this high right here. Is the breakout at this point significant? Yes. Should it warrant a move to the upside like it did? Yes. It had a high here broken along with this trend line here, along with this parallel trend line here. There's multiple reasons to think the market might break, and it does. All right? But as in all trades, you have a direction, a bias, you have a position, you now need to have satisfaction. You need to move higher and higher. And when the market fails to move and sustain a move above this high right here, above this low right here, above this area right here, these are what I call remembered lines. I put them in the chart here. What does the market start to do? It starts to come back down again. And when we break back within our main channel right here, what does that tell you? Well, there's a chance that the market should go lower. Can you define your risk? Well, yeah, I'll put my risk at this line right here that corresponds with these highs going back to here, and you have multiple reasons to. So can you define your risk? Yes. Do you have multiple reasons to do a trade? Yes. Is that a good trade? Yeah. And take it, all right? Take it. And then when the market comes down, let's measure this in a retracement. It comes down. Oops. Comes down a little bit more than comes down through the 38.2 and goes through this trend line right here. You have a little bit more confidence to move to the downside. Eventually it starts to move its way back up to the upside. I don't want to confuse this chart any more than it is, but what I do want to point out in the last few minutes of time that we have here before we get into any other questions that you may have is that by defining these lines here, what else can we look at this chart over the last few days? Well, yesterday when the market started to move to the upside, where did we stop? We stopped right against that trend line right there. This was now the 1, 2, 3, 4, 5, 6 times the market went above that level. These other times, or tested that level. These other times when the market broke through it and came down through it, the market moved in a directional bias through the level and started to move to the downside. The next time the market came down today, last night, as a matter of fact, where did we find support? We found support against this trend line. Why did we find support against that trend line? Well, because we have the trend line and we have this blue line right here. What does that blue line represent? 100-hour moving average. So we had multiple reasons to think that the market might find support against that level. Can you look across the screen here and see this other highs right here where the market broke to the upside here after finally finding a ceiling at this level right here? Yeah, you can. So the market had good enough reason to think that this would be a low, and the market indeed found support and moved back to the upside. Today in New York trading, where did we find resistance? Against the top side of the trend line. Why do we find resistance against the top side of the trend line? Because these markets are volatile. These markets are news-driven. These markets have traders who are looking to get out of trades that are profitable at levels that make sense. They're also looking to get into trades that may make sense from a perspective of anywhere where they can define the risk and see, and hopefully they'll have traders' luck and the market will move in their direction to the downside. So that's what we're seeing here in the market, and the market has indeed started its move to the downside here. It took this resistance against 12 level at the top side, and for whatever reason, I don't know the news why the market went down. I've been doing webinars all morning, so I haven't really been paying attention to the market, but as far as what they're talking about on CNBC, but I don't need to know that. All I need to know in this market right here is that the line came in at the 17 level here at the top, and the high for the day came in at 145.16.5. Is that good enough for you? I don't know, but it was good enough for me. Sold the market, and the market came back down to the downside. How can you explain when it goes to the trend line is my question. If anyone else has any other questions, rifle them in right now. I got about 5 minutes of question and answer times here, so get them in while I can. So here's an example when the market moves to the trend line. How do you know? How can you explain when it goes through the trend line? Well, what you're doing, Boyke, when the market goes through a trend line is understanding that this trend line here is something that not only you see, but other people see, okay? That's the benefit of the foreign exchange market, a benefit of trading in a market that's $4 trillion. It's also the benefit of trading in certain currencies within the foreign exchange market that may allow that trade a lot of volume, like the euro versus US dollar. So when you see something, a key level like this happen, what should happen? And the thing that should happen is that the market should go higher. So what causes it to go higher? There's more buyers and sellers. There's people out there. There's something else going on that allows the market to move to the upside. So what will allow the market to move to the upside? People who are short have to buy back, and they're on their knees hoping that the market will find resistance against this top trend line. They cover. The smart traders who see these levels and who may be sold against this level are covering as well, and maybe going long as well. If you're long from down here, when the market breaks below the trend line here, comes back above, and you go long at this level because it's also a remembered line here, or a line where there was action. Look at the highs here. We broke through it. We broke down below it. We used it here. We used it as resistance here. We used it as support here. So when the market breaks through this level here, and you went long, you're probably taking you could be taking your profit here. Well, if you want to stay with the trend because you think the market's going higher, you buy when it goes above it. So you're buying. Why? Because it's giving you a multiple reason to buy. So that's why we get this move to the top side. The fact that it doesn't stay above that line, I don't know how far it's going to go, but I know that it should go to the next target. When it doesn't get to the next target and it moves back below the trend line, I got long here. I'm getting out here. I still made money on the deal, right? I still made money on the trade because the market broke to the top side. It broke through a key trend line, a trend line that's a parallel, a trend line that's an old high, a trend line where I have multiple reasons to get in the market, and it did what it was supposed to do. So that's so the point is, folks, is that these trend lines don't work forever, okay? And a lot of times they'll break and they'll accelerate the trend to the upside. What you want to do is make sure that you understand that you can take this trade too because it's accelerating to the upside, but if it moves back in the channel right here, get out. So in this case, the market held this level, came back down. So you're selling here and you're selling here. At this point right here, you lose. At this point right here, you win. At this point right here, you win. Okay? At this point here, you lose a little. Okay? That's how it works. Any other questions? Questions? What is the smallest time chart you enter a trade in? Okay, here let me give you a quick synopsis of what I do here. Okay, excuse me. So I look at the hourly chart, I look at the 5-minute chart, and I look at the daily chart. And the reason why I look at all three charts is because there are shorter-term traders out there who just look at the 5-minute chart. I don't necessarily think that's the way to go, but there are people out there who just look at the 5-minute chart because they're trading intraday, okay? That is their excuse that they trade intraday. Now, there are other traders who will look at the hourly chart. They may be intermediate, call themselves intermediate traders, and they are just looking at the hourly chart. Then there are other traders who are longer-term traders, and they're just going to look at the daily chart. They're just going to look at that chart, right? So what I propose everyone do out there is that you need to be aware of where the key levels are in each of these charts. And so let's go to the 5-minute chart here. And off the 5-minute chart here on this chart, we see a huge trend to the upside, don't we? And we see the market moving to this high right here. And what is there to say that this trend is not going to continue in the 5-minute chart? There's nothing. Everything is looking rosy up here on the 5-minute chart here today, isn't it? It's above the trend line. In fact, it tested the trend line right here. But what I would be doing is saying that's okay. That 5-minute is bullish right here. But I'm looking to look at the hourly chart, and I also look because I'm looking at all these three time periods and look at these three sets of traders. And if I look at the hourly chart, I see a different perspective from the hourly trader. I see a trader who's looking smack at a trend line that has held 5 or 6 or 7 times, and in fact it held yesterday. And they're looking at this level right here and saying, I can't wait to sell at that level. The 5-minute guy is saying, I feel really good about this position. The hourly guy is saying, I'm getting out of this position and starting to move to the downside. So this is where you start to mix and match charts on the 5-minute chart. Well, I didn't have the moving averages in here. We're well above the moving averages. Put in the moving average here. Blue, there we go. Insert indicator. We're well above the moving averages here. Everything's bullish in this chart, but the hourly chart is showing me something different. Let's go to the daily chart, and the daily chart is it broke above this trend line at 144.98, so that's showing a little bit of a more bullish bias here. But we have to get through this trend line on the top side when the market starts to come down, starts to move to the downside. So I actually took a signal from took my clue from the hourly chart here when the 5-minute chart is showing all bullishness here. So I was selling against this level here. Now off the hourly chart, you can take your signal here off of this line as well. But the point is, folks, is that both these charts, in fact, all three charts, look where the line breaks through the line at 145.00. And remember the daily chart, it was at 98, is this trend line right here. So the fact that we held 100, and then you start to look for targets, we've got to get through the 145 level on the 5-minute chart. Then we have to get to the 98 level. And once we broke through this level, you can see how the market really started to move to the downside. Now you put the Fibonacci retracement here on the chart, and we're right at the 50% retracement, right at the 100-bar moving average. So, this short that I have here may be a time for me to cover this short, and just if I want to sell out, I can sell again below that line. All right. I hope that helped you out. So I'm pretty much done here for today, unless there's any other questions. Thank you very much, everyone, for tuning in here. I really appreciate the time and the effort from the people at FX Street. This will be available usually the next day for review. If you thought it was good, go on Twitter. I'm on Twitter, Greg Mike FX. Greg Mike FX is my Twitter. My email address is greg@fxdd.com. If you want the slides, I'll be happy to sell them to you. I'll also be happy to sell them to you if you want to. I have a book out called Attacking Currency Trends. Trends.com. AttackingCurrencyTrends.com. For you and for you alone, if you put in the coupon code TRENDS minus $7 minus $7. I offered this to the people at the San Francisco Money Show, and I'll extend that offer to you as well. That would be $30, much cheaper than the Amazon price of $37. So I look forward to having, if you have interest in that as well. I work for FXDD. I'd be happy to, or if you have any interest in our firm, send me an email, greg@FXDD. I'll have someone get in touch with you. How many pages is the book? Awesome book, Chapter 5 and reading. Thank you very much, Silver. Hey, if you have a good, if you like the book, go into Amazon and or not even if you like it. Go to Amazon. The way traders find out about good books or bad books is by people's reviews. Go in there and put a review in there. I don't care. Go. All right. Thanks a lot, everybody. Bye-bye now.